What's up, everybody? Josh Bennett here with Money Masters. Wanted to take a quick second to review the tax plan that was just issued by the White House. So there's been a lot of speculation and a lot of back and forth in terms of what we could possibly see, from the Democrats as a way to fund their social spending agenda. So there's been a lot of speculation on what could happen with the tax bill, and a lot of, frankly, fear out there as it applies to potential increased capital gains rates and increased marginal tax brackets and all these different things. So I want to at least kind of go through what some of the things are looking like that are potentially going to get added to this bill. So one of the big things from the get-go is a 15% minimum tax on corporations. So this is a big change just because a lot of corporations, both here and locally, will have pretty significantly lower tax rates than they probably should. And especially there's been a lot of instances, Apple came under a lot of scrutiny for moving their headquarters to Dublin, Ireland, as a tax avoidance strategy, because Dublin, Ireland has a much lower tax rate than the United States. So they were getting taxed about 3% there, if my memory serves me correctly. But so there's different things like that companies have been doing to sort of do tax arbitrage globally. So one of the initiatives with this plan is to have both local 15% minimum tax, but also they're rallying countries across the globe to have a international 15% corporate minimum tax. So that way companies can't do this global arbitrage thing. So it's expected that it's going to add a significant amount of taxes back into funding this plan. Another interesting one is a surtax on stock buybacks. So a big strategy that's been going on, it's been going on for most of history, but one of the things that's really been going on lately that we've seen is companies, since we've had low interest rates, is companies have basically taken on debt and doing what are called stock buybacks. So if you have nowhere to actively invest your money as a business, you don't necessarily have room for growth. But one way to boost the stock value or stock price is to have less shares of stock out in the public markets. So what companies have been doing to boost their stock price and show stock returns is basically taking stock off the grid, if you will. So they've been basically using this cash to buy their own stock and limit the number of shares that are on the market. So this is a strategy that essentially can boost stock value without really providing any tangible economic benefits. So what the new tax proposal actually is giving a 1% surcharge on any stock buybacks to encourage companies to actually invest in things like higher wages, innovation, and stuff, instead of just buying back their company shares. I have sort of mixed feelings on this because I think innovation and driving forces for innovation are an awesome thing you can do. But one of the things that companies tend to do instead of stock buybacks is things like dividends. Dividends are basically income that comes from the company to you as an investor. Well, a stock buyback is a use of cash to buy back shares, right? And a dividend is basically a use of cash to pass profits back to investors. Both provide investors a return on investment, right? But stock buybacks are a non-taxable return, whereas dividends are a taxable return. So yeah, the idea is that hopefully you're encouraging companies to innovate and invest in things that could grow the company in other ways or invest in their employees, but history has shown that's not always the case. If they have excess cash, they're more likely to do a dividend. So I'm not sure I necessarily agree with this, but it's an interesting strategy nonetheless. Millionaire surtax. So one of the things that they're adding, this should come as no surprise based on sort of the trend that's been going on amongst Democrats with the sort of the tax the rich, I guess campaign, if you will. So they're interested in basically adding a 5% levy on incomes that are above 10 million, and additional 3% on incomes that are above 25 million. And that's on top of the current tax, top tax rate, which is 37%. So that would basically equal a 45% total higher income tax bracket. And this would only affect about 0.02% of Americans. So that's something that's been gaining a lot of popularity, especially amongst Democrats. Expanding Medicare tax on the wealthy. So there's already a 3.8% Medicare surtax on earnings. But this would basically close provisions that a lot of wealthy Americans sort of avoid that 3.8% surtax by just creative accounting, and this would be sort of close some of those loopholes to basically have more Americans paying for that 3.8% Medicare tax. Another one that is added in there, and this I sort of disagree with, is a limit on business losses. So for LLCs, things like that, it's going to limit the amount of losses. And I don't know exactly what the provisions are around those losses, but it's going to limit the amount of losses you can take as an LLC business owner. And one of the reasons I disagree with this, and why I think it can have a huge impact, is that a lot of people start businesses, and most businesses in this country are LLCs and pass-through entities, and it's going to, I think, deter a lot of would-be business owners that want to start a business, if nothing else, from the monetary incentives or tax incentives to do so. It's going to discourage them because they can no longer capture as many of the tax benefits as they otherwise would. So it's essentially encouraging employment as opposed to encouraging people taking risks to start businesses, which I think are the real backbone of driving innovation in this country. The real backbone of growth in this country is small business owners and people taking that risk. So not necessarily sure how I feel about that one, but it's going to be interesting to see how that plays out in terms of limiting losses for business owners. Another big one, and this is one that's come under a lot of scrutiny recently, is increased IRS enforcement. So one of the things the bill wants to have is boost the number of IRS employees, as well as provide more infrastructure for technology and ways for auditing and tracking basically tax avoidance or downright tax evasion, and in terms of just the general public as well as businesses. So one of the things that's been really controversial is even tracking bank deposits. So one of the original proposals was to have anything over $600 be tracked by the banks. So things that this could affect are, for example, servers or people that work in the service industry that rely on tips that may or may not report all their income. Well, the IRS is going to sort of come after these type of situations where people are sort of actively avoiding taxes in cash-based industries and things like that. Or if like you sell a used car, that you don't report the capital gains on, well, that's something now that could be tracked via the IRS's developments in technology and possibly this $600 oversight. Again, the oversight with the $600 has come under a lot of scrutiny, and that's even perceived as a gross overstepping of government powers. So there have been Democrats that have actively opposed this, and that's part of what's been blocking this bill going through in the first place and why these amendments are coming out. But nonetheless, we could see increased oversight from the IRS, as well as increase in just the power and the number of employees the IRS has. So, which not necessarily a fun thing for most people out there. The last thing would be basically end a Trump era policy for drug manufacturers that offer rebates to pharmacies to benefit the managers. So that one, really only benefits people in the pharmaceutical industry. So most Americans, I don't think, are going to have any problem with that, and it shouldn't really affect most Americans. The big ones that are going to affect most Americans are the IRS increases, potential business losses, and things like that. And if you're a wealthy American, it's going to affect you as well, just with the increased tax rates. So some interesting things that are baked into this new tax strategy. What's going to end up happening with this? Who really knows? But at least seems like they're taking some of the more controversial things off the table, like the increased tax rates, especially for capital gains, the wealth tax on capital gains, and some of the things that have been proposed out there. But again, we'll kind of see what happens from here, but this is the most recent release with the Biden administration. So hope you found this useful. Make sure you subscribe and like to get more content similar to this, as well as just general financial education. But until next time, cheers.